Before I touch a single piece of data tonight, I need to look you straight in the eye and tell you exactly what the system just did. The main channel, the archive we built day by day over months of tracking the reality of this market, is completely gone. They wiped it from the platform, no warning, no trace, just an empty link. And they did it on the exact same day they slammed the price of silver down by 9.18%, dragging it down to $76.34 in a single brutal trading session. You have to understand that this is not a coincidence. This is a synchronized psychological weapon designed to shake the weak hands out of the market just as the structural reality begins to fracture. They want you terrified of the drop, blinded by the red on your screen, so you walk away before you see the vault doors closing. If you understand that the price feed is an illusion meant to cause panic, and you want to keep seeing the math they are trying to erase, hit the subscribe button and like this video, because this backup channel is now the front line. We are going to break down the fractures that caused Friday's crash and why the institutions are quietly doing the exact opposite of what they are telling you to do. Let's look at the first fracture that caused Friday to bleed. It was the reality of what did not happen in Beijing and how the financial media spun a masterclass in misdirection. The summit between President Trump and President Xi Jinping had been built up for weeks as the grand resolution to the global trade gridlock. The market was pricing in a formal extension of the 90-day tariff truce, a truce that was the exact narrative engine that had carried silver from its March cycle low of $67.90 all the way up to its early May peak above $87 an ounce. But when the leaders stepped to the podium, the deliverable was virtually non-existent. There was no operational timeline to secure the trade routes. There was no joint statement on Iran. There was absolutely no breakthrough on Taiwan semiconductors or rare earth metals. The only thing they handed the press was a single Boeing aircraft order. That was it. That was the entire trade win the market was given to chew on. And you have to understand how the modern market operates. It is not driven by humans sitting at mahogany desks making rational, long-term decisions. It's driven by algorithmic trading machines reading news headlines in milliseconds. The moment those algorithms scanned the press release and registered the absence of the words tariff truce extension, they ruthlessly unwound the trade. The optimism vanished, and the massive leg up that silver had enjoyed was liquidated in real time. Friday's crash was as much about a failed geopolitical summit as it was about the underlying economic data. It was a repricing of geopolitical failure. But the geopolitical theater was only the opening act. The second, and far more devastating fracture, is the inflation feedstock. This is the engine of everything happening at the Federal Reserve right now, and the numbers are terrifying if you know how to read them. The April Consumer Price Index, released by the Bureau of Labor Statistics, printed at 3.8% year on year. The consensus on Wall Street was expecting a cool 3.7%. Instead, we got the hottest annual reading since May of 2023, and the underlying core consumer prices ran at 2.8%. But if you want to know where consumer prices are going tomorrow, you look at wholesale prices today. The April Producer Price Index came in at 1.4% month-on-month against a consensus that was sitting near 0.4%. The trailing 12-month wholesale number printed at an explosive 6.0%. That is the hottest wholesale inflation reading in nearly 4 years. The Bureau of Labor Statistics confirmed that nearly 60% of that wholesale advance came from a massive jump in services prices. That is exactly the part of the inflation tape that the Federal Reserve weights the heaviest because it is the stickiest. Once services inflation gets entrenched, it is nearly impossible to crush without inducing a brutal recession. Import prices and export prices both surged at the fastest pace since 2022 in the exact same week. We had 3 separate inflation prints, 3 separate beats against expectations, and 3 separate confirmations that inflation is accelerating, all stacked into one 5-day window. The bond market took one look at those numbers and violently repriced the cost of money. The yield on the 10-year Treasury note closed Friday at 4.59%, up 10 basis points in a single session and marking the highest close since February of 2025. The 2-year Treasury yield closed at 4.09%, its highest level in 14 months. The United States dollar index spiked to 99.27. When the yield on government debt spikes that hard and the dollar strengthens, the algorithmic math of holding non-yielding physical bullion swings violently against you. Silver, which is far more sensitive to interest rates than gold because of its massive industrial component, takes the hardest hit. Just 2 months ago, the futures market was pricing a 48% probability of a rate cut in June. As of Friday's close, that probability has completely collapsed to under 8%. Traders are now assigning near zero probability to any Federal Reserve rate cut at any point in 2026. In fact, they are pricing in a 50% chance of a rate hike by December. That is 40 percentage points of monetary risk repriced inside of 7 calendar days. Friday was a violent, unfeeling verdict on the rising cost of money. Nothing more, nothing less. And look at the absolute chaos regarding who is actually running the monetary system right now. The institutional plumbing of the central bank is fracturing at the worst possible moment. The United States Senate just confirmed Kevin Warsh as the 11th chair of the modern Federal Reserve on a vote of 54 to 45. That is the slimmest confirmation margin ever recorded for a Federal Reserve chair in the history of the institution. He is walking into a divided, deeply politicized environment. And his predecessor, Jerome Powell, has stated he intends to remain on the Board of Governors, citing the ongoing administration investigation into his prior conduct. That is the first time in nearly 80 years that an outgoing chair has remained on the board after stepping down. Warsh is walking into his first sitting Federal Open Market Committee meeting on the 16th and 17th of June with the hottest inflation tape in 4 years, a divided board, and an outgoing chair looking over his shoulder. At the last meeting, 4 members dissented, demanding that the easing bias be removed entirely. Several participants have publicly stated they would support upward adjustments to the interest rate target if inflation remains hot. If that June meeting produces a dot plot that officially drops the single rate cut previously expected for 2026, the downward pressure on paper silver will be relentless. But to understand why that inflation tape is so hot, you have to look at the 5th fracture, the Strait of Hormuz. We are witnessing the single largest oil disruption ever recorded, and it is the upstream pipe feeding the entire inflation surge. West Texas Intermediate crude oil futures climbed to roughly $154.20 per barrel into Friday's close, booking a weekly gain of approximately 11%. Brent crude settled around $192.26 per barrel. The strait remains under a dual blockade. According to the International Energy Agency, crude and fuel flows through the strait fell by approximately 4 million barrels per day in March and April. Saudi Aramco's chief executive warned investors that the global market loses approximately 100 million barrels of supply every single week. The strait stays closed. The cumulative net loss is approaching 900 million barrels since the conflict began in late February. Aramco has ramped up its pipeline workarounds to 7 million barrels per day, executing the largest logistics shift in Middle Eastern history, but it is not enough. The harsh reality is this. Saudi Aramco is publicly stating that if the strait does not reopen by the middle of June, the global oil market will not structurally normalize until 2027. Oil is the base layer of all economic activity. If oil stays at $150 a barrel, manufacturing costs explode, transportation costs explode, and that inflation is passed directly to the consumer. That is the exact mechanism making the Federal Reserve's job mathematically impossible. This brings us to the most crucial part of this entire analysis, the historical parallel that explains the great illusion you are watching on your screen. The registered leverage ratio on the commodity exchange is currently sitting at approximately 6.22. That means for every single ounce of physical silver sitting in a registered vault ready for delivery, there are over 6 standard paper claims floating around the digital ecosystem. Over 3,000 contracts remain open for the June delivery cycle, which equates to about 15 million ounces of delivery exposure. We have seen this exact setup before, and it ended in a systemic financial earthquake. In the 1960s, the Western central banks formed the London Gold Pool. Their explicit goal was to suppress the price of gold and keep it pegged at $35 an ounce to maintain the illusion of a strong United States dollar, even as inflation ran hot to fund the Vietnam War and domestic spending. For years, they successfully manipulated the market by dumping massive amounts of paper, gold, and leased physical gold into the London market every time the price threatened to rise. They wanted the public to believe the dollar was supreme. But while the West played a shell game with paper derivatives, the smart money in Europe saw the underlying mathematics. Nations like France, led by Charles de Gaulle, realized the United States was printing more paper dollars than they had gold to back them. So, instead of playing the paper game, France quietly and relentlessly demanded actual physical delivery. They sent battleships to New York to load physical gold bars and bring them back to Paris. They drained the vault. And in March of 1968, the drain became so severe that the London Gold Pool completely collapsed overnight. The paper illusion shattered, the vault doors slammed shut, and the price of physical gold exploded, leaving anyone holding paper claims completely wiped out. The exact same wealth transfer is happening right now under the cover of Friday's price crash. While the Western retail market panics over a 9% drop in a rigged paper derivative, the Eastern central banks and institutional buyers are executing a ruthless accumulation phase. The People's Bank of China just reported its 18th consecutive month of gold purchases, adding 8 tons in April alone. Their official gold holdings now stand at 2,322 tons. Chinese gold imports surged on a net basis to 143 tons in March alone, bringing their first quarter net imports to an astonishing 316 tons. That is an increase of 333% year on year. Silver does not show up directly in official central bank reserve data, but the surrogate indicators are screaming. The Shanghai silver market continues to print a premium of roughly $10 per ounce over the Western spot price. Do you understand what that means? The smartest, most conservative buyers on the planet are happily paying a massive premium to secure physical metal while the Western markets liquidate paper. Over in London, the vault data shows the total silver held in the London Bullion Market Association system dropped by over 1 million ounces in a single month. The iShares Silver Trust has bled over $447 million in net outflows over the past month. The paper side is bleeding out in terror, while the physical side is absorbing everything it can carry. Two entirely different conviction levels are operating in the same metal at the exact same time. Now, as a serious analyst, I refuse to ignore the bear case. This desk does not skip the counterargument, and Friday's tape gave the bears a tremendous amount of fresh ammunition. The threat of severe demand destruction is very real. Analysts at UBS just slashed their full-year silver investment demand forecast down from 400 million ounces to 300 million ounces. They also cut their silver deficit estimate from 300 million ounces down to a microscopic range of 60 to 70 million ounces. If that structural revision holds, it pulls a major plank right out from under the supply deficit narrative. Over in India, which is historically one of the largest physical bullion markets on Earth, the government just doubled its import tariff on gold and silver from 6% to 15%. That is a direct, artificial shock to physical demand in a key region. Furthermore, the photovoltaic solar sector, which has been the darling of the industrial silver demand story, is actively thrifting silver out of their manufacturing processes. Demand for silver in solar cells is forecast to fall by a further 19% this year, down to 151 million ounces, as manufacturers switch to copper-based contact cells and silver-free technologies to cut costs. And then you look at the consumer. The University of Michigan just released its preliminary consumer sentiment reading for May, and it came in at 48.2. That is the absolute lowest reading on record since the survey began in 1952. The public is exhausted. Inflation expectations remain pinned at 4.5%. When the consumer is completely tapped out by food, energy, and housing costs, they stop buying electronics, they stop buying automobiles, and industrial demand for silver inevitably craters. That reality was violently reflected in the mining sector on Friday. First Majestic Silver crashed almost 10%. Hecla Mining dropped nearly 8%. Pan American Silver and Core Mining were utterly decimated in the downdraft. The market is looking at all of this: the hawkish Federal Reserve, the collapsing consumer, the industrial thrifting, and it is pricing in a severe deflationary bust for industrial commodities. The algorithmic models are calling for silver to drop another 15% down to $64 by the end of next week. None of these data points rewrite each other. They are stacking up, layer by layer, building a pressure cooker that the paper markets are desperately trying to ignore. The algorithms and the institutional short sellers are terrified of a few basis points of interest, while the Eastern central banks are quietly backing up the truck and taking physical delivery. The 16th and 17th of June Federal Open Market Committee meeting is the next real inflection point. Until then, you are watching a violent consolidation, not a structural breakdown. Pay attention to what the system does, not just what it says. They are telling you exactly what they fear by silencing the channels that track the raw math. The main channel was completely wiped out because it refused to play along with the illusion. But the data stays yours. You must verify every single source I cited tonight yourself. Go pull the Bureau of Labor Statistics reports. Pull the London Vault data. Look at the Shanghai premiums. I do put extra links in the video description below, but just to verify the data sources so that you can have two-way transparency and clarify this for yourselves. If this changed how you see the system, drop a comment below and subscribe to this backup channel. OG out.